Good morning and welcome to today's Five with Fitz. I'm Keith Fitz-Gerald. Thank you, as always, for spending a few minutes of your valuable time with me. So let's get to the markets. And here we go again. The markets are, of course, split as I record this. Today, both the Dow and the S&P 500 are green, while the tech-driven NASI is red as I record this. Now, usually it's the other way around. It's the S&P and the NASI that are green or red, and then the Dow is going the opposite direction. So this is interesting. But what I want to impress upon you is, as troubling as that may appear at first glance, or the media wants you to believe as they get into it today, don't let what's happening knock you off course. Volatility isn't the enemy. It never is. It's the price of admission. It's important you think about it that way if you want to be a successful investor. So, here's my playbook. Today, number one, GM's dead cat bounce. GM's popping today after beating top and bottom line expectations, meaning that it made more money and brought in more revenue than Wall Street spreadsheet gang thought it would, and even raised guidance for the rest of the year. Now, EPS was good, 296 versus 243. That's a big one. And revenue hit 48.8 billion versus 44.6 billion. So again, also really good. Shares are up 14%, give or take, or $8.33 as I record this. Now, what's interesting about this is that I learned a long time ago that whenever situations like this one arise, it's often a good bet to see what's on the other side of the proverbial trade. So, for example, CEO Mary Barra, who's very, very smart, says her quote, top priority is to get margins back to 8 to 10% by driving EV profitability. Good luck with that. I mean, really, there are far better long term plays in next gen mobility, and none of them come with Detroit's baggage, like, oh, I don't know, Tesla. Just saying. Anyway, here's an investing tip in this department. Investing isn't about collecting stocks like people think. If you want to win, you've got to play to win. Most people, most investors play not to lose, but do so anyway. Case in point, GM has returned 93.5% and 149.6% over the past 5 years and 10 years, respectively. Tesla has returned 216.57% and 3,034.96% by comparison. Just saying. Number two today, dividend investors, beware. Coke's fizz is fading, at least in my humble opinion. Coca-Cola beat Wall Street's estimates as well this morning, posting Q3 earnings of 82 cents a share versus 78 expected, with revenue up 5% to 12.46 billion. That's the good news. Now the bad news? Well, demand's still flat in North America and Latin America, and the company's products are not exactly flying off the shelves elsewhere either. Coke's so-called unit case volume, the number they use to measure this stuff, rose just 1%. Just 1%. Mostly thanks to bottled water, coffee, and sports drinks. In other words, the classic Coke products that you and I grew up with are as flat as a week-old soda. Which brings up something kind of interesting. Dividend investors love Coca-Cola because it's a longtime Buffett fave, and B, a dividend king with 50 plus years of uninterrupted dividend increases. Now, I think Pepsi's the better bet here and right now, in my humble opinion, if you're into the fizz. Diversified portfolio, stronger global growth, 3.62% yield, which edges out Coke's 2.86%. Plus, Pepsi's undervalued, and there's a good argument to be made that it could be poised for a rebound. Makes me think, anyway. All right, number three today. Still a no-brainer investment choice. This always makes me take a deep breath, but unfortunately, war, terrorism, and ugliness remain growth industries. Now, Lockheed Martin just proved it yet again. The world's largest defense contractor beat expectations, posting Q3 EPS of 695 versus 635 expected, and showing real progress on long-delayed programs like the F-35 fighter. Now, should you buy it? Lockheed Martin, that is. My POV is that the better question is why you wouldn't. History shows very clearly that conflict drives innovation and profit potential, and not just in the defense industry either. Demand for AI-enabled defense, cybersecurity, and next-gen weapons platforms is at an all-time high and still rising, which is why I continue to favor top-tier names in this space. Should you buy Lockheed Martin? Well, before you do, consider that AI plays a far more significant role in defense than most folks believe, and that there's considerably more upside in derivative investments related to it that defense contractors must have in order to operate. One of my fave, for example, has returned 116.32% over the past 5 years, or roughly 6 times more than Lockheed Martin. Now, hopefully you got this covered in your own investing, or at least thinking along similar lines. If you'd like some help, you know where to find me. I'll be right here. Number 4 today, Apple's weakness has aged like fine wine. Now, Apple shares hit all-time highs yesterday following the news that iPhone 17 sales are up 14% compared to last year's iPhone 16 during the first 10 days of release, with, get this, China and the US leading the charge. Now, I hate to say I told you so because I hate that expression, but in this case, I did. Explicitly. In fact, I was speaking to Liz Clayman on April 8th at a time when most investors thought the end of the financial universe was upon us, and I said 2 things during my interview. Number 1, that weakness is a buying opportunity when it comes to Apple, and 2, that I expect Apple to double or triple in 3 to 5 years. And you can watch that interview elsewhere on my channel. There's a link there in the channel. There's also a link in the written version of today's 5 Fits. Anyway, don't want to get off topic, but so far so good is the takeaway. Apple has returned 45.63% since then versus the S&P 500, which has returned a respectable but still less 32.98% over the same time frame. It's tasty, pardon the pun. Anyway, number 5 today, Warner Brothers Discovery. Quote, now accepting lowball orders and Hail Marys. Let me explain. Warner Brothers Discovery says that it's open to a sale, and shares have jumped roughly 9% on the news today as I record this. You can't make this stuff up, right? Earlier this year, the company announced plans to split into 2. One entity focused on streaming and studios, the other on global networks. Now it's apparently reviewing all strategic options after getting multiple unsolicited interest from various parties. Now, CEO David Zaslav says that the goal is to, quote, unlock value, which is corporate speak for, hey, please buy us before the next earnings call. That never outruns disruption, folks, ever. Warner Brothers Discovery has been trying to reinvent itself since the last reinvention. Meanwhile, Netflix, Disney, and even Apple have eaten its lunch. Now, I noted a while back that I think Oracle and Ellison family may make a run at the company, and the rumor mill says they're amongst the suitors, which I think is fascinating. So my advice in this instance is stick with strength, a la Oracle, if you're going to play along. Team Ellison, meaning Elder and Junior, has the means, the motive, and the mojo to reinvent the entire industry, and not to mention a proven track record of doing so. So here's an investing tip. Deals like this one tend to usher in entirely new paradigms in staid, antiquated industries. Now, I personally think the deal sparks a complete reset for conventional broadcasters, which are plagued by increasingly limited content budgets, shitty shows, excuse my language, declining and fragmented viewership, and legacy debt that hobbles them, or worse. Now, unfortunately, there's not an old school only broadcasters ETF for me to short, but I sure as heck wish they were. Bottom line, it makes no sense whatsoever to apply the same old tired analysis that everybody else does, but expect different results. Think differently, embrace change, invest in the best, ignore the rest. As always, let's make it a great day. You got this, I promise, and I will see you tomorrow. Thanks for watching.